and welcome to Finextra. I'm Emily Horler and I'm here at Cyboss 2015, speaking to Darryl Twiggs from SmartStream. Thank you very much for joining me.
Hello.
So why are financial institutions looking for cash management solutions from the front office?
Emily, cash management is traditionally the responsibility of the back to middle office. They're taking control and management of the bank's accounts at their counterparty agents. Okay? And really what they're looking for is the flow of currency from the bank to those accounts and ensuring that they are adequately funded. New regulations which have been in play over the last 24 months or so are really forcing the banks to look at the systems controlling liquidity of the bank overall. That is from the front office through the middle office to the back office. And to do that in a real-time or intraday model. So really it's becoming increasing the responsibility of the front office to ensure that the bank itself has adequate funding. Okay. So this is putting pressure on the banks to ensure that they've got robust management controls, reporting capabilities and alerting capabilities to ensure that all the trading activity that the bank's undertaking is adequately funded. And because the trading activity is the responsibility of the front office, naturally the banks are now looking at their controls and management processes that are occurring at the point of initiation at the front office.
So are regulatory requirements putting pressure on the front office, and what regulations do you see in play?
Well, I mean, it really comes under the Basel Committee of Banking Supervision Regulation 144 as an umbrella regulation that affects the complete bank. Traditional back office is looking after cash management, is very much focused on the balances that they hold in their accounts at their counterparty banks. And under Regulation 144, Principle 8, the bank is required to put in new controls that will monitor liquidity and, in fact, report by the second on the balances throughout the whole bank. The responsibility of the front office is to manage the funding of the bank itself, the street position of the bank. And the only way they can do that is by actually now encapsulating and bringing forward cash management controls, and in particular liquidity controls. One of the consequences, of course, is that they need to understand all transaction, all cash flow activity that's occurring across the whole of the bank. And that's a responsibility not traditionally taken up by cash management themselves, who are merely looking at the cash flows between their bank and their accounts of their counterparty. So the front office need a tool now to be able to understand how financial transactions between different lines of business are impacting on their liquidity and then able to ensure that they have sufficient liquidity and funding for their trading activity.
So do you see benefits in real-time visibility for the front office?
Absolutely. I mean, we all live in a volatile market space, okay? And the traders will like to be able to know exactly what their funding positions are in order to take advantage of a moment of opportunity. But also, the regulators are imposing add-ons, as they call it, to their liquidity holdings. These add-ons are basically to de-risk positions of exposure where there are weak controls in liquidity and funding. So if we were to have a bank with a front office system that is monitoring all financial cash flows, okay, both internally and externally, they would know second by second what their true funding positions are. Those add-ons would no longer be required. That money, that capital, can then be reinvested by the bank.
Darryl, thank you very much.
My pleasure.
And thank you for watching.